Good morning, beautiful people of the internet, and welcome once more to the Sunday Special Live. We have upgraded today, and I think I can say that because Adam's not going to watch today's episode because he's not on it, to Saif Derzi. We have Saif Derzi in the house once more. Helen, Chorley, Piotr Rusinek, and myself, Jay Howard, and we are here to talk all things, anything, at any point in time. This one is likely to be a bit of a hodgepodge, but it's going to be good fun. Make sure that you comment and you take part in today's episode because interaction makes the world go round. So
last week we also had Saif. Would you say that was an upgrade too?
It was a massive upgrade. Yeah. God, I mean, I don't mind saying it. I'm not precious. It was an upgrade. I'm surprised I got invited back. That's how much of an upgrade it was.
Oh, nice one.
So I hear Adam's Sunday supplement was as humble as always. That he just kind of detailed the news and that's it. He just moved on immediately. It sounded good.
So the first
I think he only mentioned twice. I told you so.
Oh, okay.
Three times. The first half was him telling us about his predictions, which, to be fair, was absolutely bang on. I think he was talking about how the Monetary Policy Committee last time was 5-4, so it was quite close in terms of obviously voting for staying the same in terms of interest rates. Whereas this time it's 6-3, and the markets have predicted it really, really well, because I was looking at the bond market, the 5-year gilts on, I think it was Friday, and it was really touching. I think it was touching very, very close to 4, about 4.09 maybe, or somewhere around there, which is very, very positive. Not seen that for a while, which meant that the sort of 5-year swaps were around, I think they're around the 4.22 last time I checked them. So basically what Adam is saying is it's very, very positive. So what happened with the Bank of England decision on Thursday was what the market was expecting. And obviously that's kind of, more of the same. So it's looking like we're going into a pretty positive start to 2024, hopefully.
Hooray. Good news. Woo.
Correct. I think the other most interesting thing that he said was how much of, I guess, a fluke it was that the UK government, out of coincidence, found this balance between the amount of savings that people have had in their household savings and wage inflation happening. Because the wage inflation lacked so much, the savings is what kind of kept everyone afloat. And that was forced savings because people were scared because of COVID and all the measures and everything else that was going on.
And they couldn't spend things, yeah.
They couldn't spend the money. Exactly. There was just no physical way for them to spend the money like they normally were. And that little savings cushion and buffer, coincidentally, took them all the way through to when they're now getting wage inflation. And he said, in real terms, it's still not really keeping up with inflation, but it's a form of, wage inflation. So he said that's why we've seen the softest landing so far in terms of the interest rate hike we've had for so many sort of years that they've hiked interest rates at. So he basically just said the government have fluked a real soft landing, basically.
I'm sure that's not how they'd spin it, but
no, of course, but
with this government, it would have to be a fluke. There's no way it was purposeful.
The last most interesting thing that Adam said, and this is kind of the last point just to end on, is he said Rishi missed a massive trick. And the trick that Rishi missed was back in 2021, where he could have done 100 million bond, for example, 100 billion bond, sorry, I think he might have said, 100 billion pound bond, which was an infrastructure bond at 0% rate or whatever it was at that point. And that could have been ploughed into infrastructure, in quotation marks. But he could have used that to basically cover all of their current debt and replace a lot of their current debt that they've currently got, which is obviously going to be way cheaper. But he said he missed a massive trick. And that was a really interesting point. But hindsight and all of that stuff, right?
And to explain that for people watching who don't kind of follow this stuff, basically he could have locked like long-term lending in, long-term borrowing in at really low rates, whereas anything they issue now is obviously at massively inflated rates, relatively. I mean, you're still talking to somebody whose very first residential mortgage was, I don't know, at least 6 or 7%. So I find it all funny that we freak out about these rates at 4 or 5%. It's like, well, actually, historically, it's not too bad, is it?
Yeah, I always do wonder, like, for example, like if the government did take that £100 billion at 0%. So basically these institutions would buy £100 billion worth of bonds at say £100, paying 0%, 0.01% for whatever number of years. So now those bonds would be worth, instead of £100, they would be worth like something like, I don't know, 40, 70. And then what impact would that have on those institutions or the banks? And because that was the problem of all the banks failing in the US, where all those bonds that they were holding that had really good kind of long-term value and they were meant to be safe, those were actually the ones falling down in value, right?
Yeah, but I think it's also at the point in time, right? So at that point, they would have not have seen what was going to be happening in a year, 2, 3, 4 years time. So I think you take what you can at that time, and that's the reason, you know, when you look at Japan and you look at their interest rate policy, and you know, you look at the some of their bonds were printed at negative interest rate territory. So that means that people are willing to lose some money by having the safety of lending to the government, right?
Yeah.
And that's a crazy theory to think about, but the reality is there was no other alternative. It's all, you know, we heard that in COVID, didn't we, Tina? You know, there is no other alternative. Well, there is no alternative. So the reality of that, I think, is at the point that they are deploying those funds, that's the decision they're making at that point. You can't foresee too far ahead within reason, because that's what the bonds are doing. You know, a lot of the markets are predicting, you know, 10, 20, 30, 40 years. That's why we have all these long dated securities. So yeah, that's kind of just the general thing.
The decision-making process also is that they've got funds maturing and they'll have new kind of subscriptions kind of coming as well. That money has to be placed somewhere. Literally has to be placed somewhere. And they are generally, or pension funds are generally very limited parameters in what they can invest in. Like they can't invest in hedge funds that might return them, I don't know, 30% per annum, but also might lose 30% per annum. They're called real money, or in you know, if they're bank clients, they're called real money because it is real physical cash. They generally can't use leverage or much leverage at all. So that money has to be placed somewhere. So like, where does it go? It's not, oh, there's a choice of 0% and it's government backed. It's the safest thing you can get. But Tina, where else can you put it? Because nothing else is returning much more than that at the time either. So they're very, very confined on where they can place that money.
Yeah, cool. It's a hypothetical thing, but I think right now, because of those interest rates and the kind of positivity that they bringing towards the future, like I think the market will be starting to change. Like if this continues for another 2-3 months, but I still think right now is like the best time to be buying things because those prices, the competition is like so limited.
Yeah, and also we're going into a winter period, November, December. It's not as positive as you'd normally have in sort of say March to October as an example. So I think it is a good time. I also think the fact that we've had another interest rate hold based on probability, we're kind of seeing the peak of the negativity, dare I say, you know, famous last words, but that's what I'm predicting. That's what I think my actions are predicting in terms of what we're doing in our business. You know, we are buying. And it's funny you say that. I mean, I listen to a lot of the American podcasts, right? And I listen to so I don't know if you guys were aware, but in America, they had the iBuyers model. So iBuyers was basically, iBuyers was it was institutional flipping, right? So flipping houses at institutional levels based on technology. So these guys were buying up houses from Mr. and Mrs. Smith or whoever it is. It's almost like a We Buy Any Home, but they were specific.
Or We Buy Any Car,
Or We Buy Any Car, but they're specific to flipping houses. And the funny is that I was listening to a podcast. They raised a lot of money in 2021. You know, it was 2021 and 2022. You could have been the worst property developer, the worst property flipper in the world, and still made money, right? It was that easy. And actually, what happened was, the worse you were, the better you were, because the longer the refurbs were taken, the more money you were going to make, because the market was actually on an upwards trajectory. And they were talking about how they've mispriced. So because they use AVMs, the automated valuation models, they've mispriced a lot of properties. So some people were selling properties to them and they were completing really quickly and they're getting above market value for some of these properties, and some other people were getting below. But the point is, they're not surviving, and all of these guys are kind of going into a period of not being able to raise more finance, not being able to make the same returns that they were making, and actually having to shut a lot of these kind of operations down. But the most interesting thing that they were talking about was there is no vendor capitulation that's happening right now. Like, vendors are still holding pretty strong because that real motivation in the market is not coming. So you're seeing all these little things coming out, you know, like maybe someone's got certain circumstances or specific circumstances. But I speak, and I'm sure you guys do, speak to a lot of the auction houses. Repossessions have not been coming in for a while. You know, it's really trickling in very, very, very slowly. And then you've also got to think about sort of, where else does motivation come from? Death, debt, divorce, right? Well, even when people have got a probate property that have inherited, they're getting a lot of money for that on the market at the minute. So they're going with agents. They're not really going to a cash buying company unless they falls through once or twice, maybe. Then that's when they'll do that. Debt, as we've just discussed, is not really there. So then really it just comes down to, where is the motivation? And there isn't that much motivation. So I think we're at this point in the market where if you find a deal or if you find a motivated vendor, snap their hand off. Don't be looking too much at where the market is. That's just my kind of take on this.
Interesting. What are you guys seeing on the auction front? Are you seeing more lots, or are you seeing motivated sellers there?
Yeah, it's a good question. I just want to say on this point of the iBuyers. Like I know there was a startup in Europe about a year ago. They raised £400 million worth of funding, and they're called Cassavo. And basically they do automatic valuations for things, and they buy property and they trade property, and it's quite a big startup. But I think they also have like an arm where they are becoming like an agent kind of thing for a lot of the things that they come their way. So I wonder how they are doing in this market.
There's a few of them coming into the UK market now. We've been contacted by a few of them that are looking to buy a portfolio. Even in today's, you know, macro environment, they are still in the market to be buying stuff up. So I think they're also looking and trying to predict into the future and thinking this is a good time. So they are looking to buy portfolios, but their sole focus is yield. They don't care about capital appreciation as much. That's just a cherry on top in their models that they kind of, you know, map out. But really, it's all about income. That is the most important factor for them. But yeah, so yeah, I think Helen brought a really good point about auctions as well. So yeah, JPR, it'll be good to see what you guys are thinking about that, I guess, and what you guys are seeing on your side.
I think we've been seeing what we would consider kind of like cornerstone style assets that you'd put into your portfolio just going unsold. Just there's no one biting. So that we saw a couple of buildings where on one of them, I think the yield on the lower guide was about 9.86%, something like that. It was almost 10%. I think you could probably buy under guide now that it's failed to sell. But in that, you know, there were some, you know, government bodies that were renting it. It's an office block. There were some local businesses that were renting it. It was serviced offices. So the service charge was 120 grand a year. The income was roughly the same. So you think about that kind of money moving into that building. Two of the tenants, I think 2 or 3 of the tenants were on like limited agreements. So just kind of 1 month notice kind of thing. But you can think if you were to get those on like the 5, 10, 15-year leases that were already in the building, the capital value of that asset shoots right up because you've got the longevity of income. And it looked like a good asset, but you know, I think it's in one of those areas where you have to know the area. You have to have relationships with commercial agents. You have to be able to be comfortable with the fact that 1 or 2 tenants may leave. In the building, there was no real anchor tenant. There was maybe 2 or 3 that were paying more than the rest just because of the size of office that they were holding. But if one of those left and 2 of the smaller ones left, it wouldn't be the end of the world. So a building like that, which is in one of the major port cities in the country, going unsold, felt a little bit ridiculous.
Right.
And there's several examples of those where you look and you think, I can't believe this. I mean, we had bid and won on something where our maximum bid was appreciably higher, like ridiculously higher. And we were shocked that we had won it at the price we won it at. It's a deal to talk about for another day. But it's kind of it's one of those kind of things where if a trader like us is turning up to an auction room and winning something 50, 60 grand below where their maximum bid is for trade value, not for build out, not for refurb, not for whatever, for trade value, that says something about the marketplace. You must be seeing the same kind of thing, Saif. You're still picking up the odd bit from auction, right, to trade?
Well, to be honest with you, I mean, this is what kind of tells me that we've still got that market, right? And the market's not fallen out of its arse for this specific reason. Anytime we've all seen properties go into auction that's really, really well priced, and you think that looks like a good deal, that looks like a good deal, it's always sold for way above what you're willing to pay for it. I'm just talking about the more vanilla stuff, not the value add opportunities and all the rest, just very much vanilla. And that to me signifies that the market is still well and truly operational, still working, there's still money to be made in the market. But what we are seeing, and I watch the timed auctions really, really well, is we're seeing people that are quite opportunistic. So it's not the naive buyers that were there 2 years ago that are going to be bidding from the start of the auction. It's the more opportunistic buyers that are thinking, I want to grab a deal here. Last few seconds of the auction, putting in bids, and it goes mental last few seconds. If anyone was watching auctions, you see that happening quite often.
Yeah, there's a lot of that.
I saw one go from 30 grand to about 70 grand. And the bid that took it from 30 grand to 70 grand was placed literally at 5 seconds before the auction finished. Wow. Yeah, that's huge. So that bid then sparked off 40 bids after that to get to 70 grand. It was in £1,000 increments. So I think the market is there. I do think for stuff like you said, Jay, where it's larger assets, it's outside of the reach of the normal people that are looking for the sub 200k style stock, and where it might need a certain, a value add eye, whether it is through planning or whether it's through, as a trader, being able to be quite creative with how you remarket it. That kind of stuff is in its own little space, really. And I think you guys could clean up with that stuff, to be fair. But I think in terms of the vanilla stuff, it's very well and truly still that kind of good equilibrium between buyers and sellers. It's just the stuff that's overpriced that's not selling,
Yeah, we sold last week. We sold a couple of things that were actually quite big, and we had a couple of people for each of those properties. But what we noticed is like every property takes so much more effort to sell than in the past. In the past, you would have more competition, people fighting over things, and as long as things are priced well, there would be like 4 or 5 people fighting over things. Now there's like, if there's like 2 or 3, it's a big party. Like sometimes it's like it requires a lot of conversations to be had, while in the past it was just listing the property, putting it in the right auction, getting the legal pack together, and then people were fighting over things.
That was going to be my question. What does more effort? What does effort look like? More conversations with interested parties, or what type?
More conversations with interested parties. That's for sure, and also working with buyers way more. So trying to negotiate things, maybe extended completion, maybe extra. I don't know, some extra things in the contract
to make them
some more flexibility and what else? Sometimes it requires relisting the property into the next auction. We actually met up with guys at Barnet Ross. That was like the best visit ever. But we met up with these guys, and they were telling us about this property in Finchley, which was like a little shop and a flat above. And it was listed in the auction in, I think, September, and it didn't sell with a 400k reserve. So they brought down the reserve to 375, and it was offered again. It sold for 410k or something like this. Like it sold for more than was available a month before. Sometimes it does require a little bit more of a timing and releasing the property maybe for the second time, and then usually it goes. What else?
Yeah, and his reasoning
else
for
is
that
really
was
good
actually
question.
really his reasoning for that was actually really interesting, wasn't it? He was like, well, look, you don't know who is waiting for a project to come out of finance so they're able to buy. You don't know if someone wasn't in a position to be looking but looked when it came up. So he said it's not always a case of finding the right time of year to sell. There is no right time or wrong time of the year to sell. You just have to make sure that the person that is going to pay you the most money is looking to buy at that time that you're looking to sell. And that turns into a bit of witchcraft and wizardry, right? You just to get a crystal ball out. But he said sometimes people just like having that little bit of extra time to just assess things, look at things, especially in this environment. You know, people want to be that little bit more comfortable. You hear from quite a few auctioneers, Saif, you'd hear it as well, is they're actually doing a lot more work than they were doing. You know, they thought they were doing a lot of work during COVID. They weren't. People were just throwing money at them to buy deals. It was crazy that, you know, that first 12 months of COVID and lockdowns, you know, it was Christmas come early for all of them. But now they've got on more properties, they're doing more work, and they're getting the same, maybe plus 5-10% in terms of results, in terms of bottom line. So they're working harder, and you're finding that they're, you know, we were talking to an auctioneer recently, and he said, well, at the moment, I value buyers just as much as I value sellers at the moment. Now, that probably sounds crazy to, you know, someone who hasn't got an auction ear or a negotiation ear in their mind. But for auctioneers, the value in their business is the sellers that they bring on.
Yeah.
The value is the properties that they take on, because the train of thought is, if it's marketed and priced well, the buyers will bring themselves. You know, they will just turn up in their droves. So the value to the business is the seller.
Have that supply coming
at the moment. Now it's okay. We have the sellers. Let's try and find out what the market price is. Let's try and see what the market is saying here. But now, equally important is making sure that buyer gets across that line, as Piotr was saying.
So more hand holding.
Yeah. So now it's kind of like, well, you can't just dismiss someone that calls up and asks a stupid question.
Right.
If something is a stupid question, right? Now you have to go, okay, well, let's hold this hand and see if this person is actually in a position to do this deal. And you're hearing more and more of that happening at the moment. So that's interesting. I don't think that means it's a buyer's market yet. I don't think that's the case, because as Saif said earlier, there's I don't know. I don't think the sellers are distressed enough for the buyers.
We're in an up and down market. We're very, very much, every week is different. And I deliberately track a lot of the, I'm not going to say the kind of commercial style auctions. I'm very much in the residential space. That's kind of my bag. But I track a lot of that. And really, every week is different. You have one week where auctions go really, really well, and you can see all of the crap in the Northeast selling quite well and all the rest of it. And you have another week when none of it sells at all. So we are very much in a market where every week the sentiment is different, but also the type of buyers we have is different. But Helen, you asked a really, really good question, and something I've not heard before, which is, you know, but what does it mean to work harder? And I think the reality is, as Piotr and Jay said really well, 2 years ago, you would list something on Rightmove, put your feet up, and it's done. It's done the job. You do not have to do any work. You just go out and have your dinner, your cup of tea, see your mates. That's it. It's done. Now, what you're having to do is list it on Rightmove, and then you're having to call all the buyers that you had for previous lots that are quite similar and say, are you in the market for another one? You might have to call a few of the traders and say, look, I don't know if this is going to sell, but if it doesn't, it might be an opportunity for you. You have to really start working that lot hard. And then you might have to do a bit more putting it onto LinkedIn, as some of the auctioneers are doing now, which actually is quite a good platform for stuff like this, to be fair.
Yeah.
But I think the reality of a lot of this stuff is, even as a trader, I'm having to work harder because our margins are getting squeezed, and people don't talk about this as a trader. Buyers are wanting better deals because they're seeing the market is falling out of its arse, which we know it's not. Sellers are like, well, hold on a minute. You know, I'm not motivated. I'm not desperate. So we're having to strike better deals for the sellers where possible, because at the end of the day, we've got overheads. We've got to keep going as a business, and our margin's going down. So what we're having to do is think, right, we were 2 years ago, everything just goes into auction. There's no questions asked. Now we're like, hold on a minute, does that need to go into the open market with an estate agent? Would they be better placed to sell that? Or do I need to be picking up the phone to some property sources who I know have cash buyers or bridging buyers that don't even look on Rightmove and try and get a deal done with them? So we're having to work hard as a trader as well as auctioneers. And I did this with Jay and Piotr. You know, I picked up the phone to them once and said, look, guys, I've got this deal. It's a really good deal. It's down in the south. You know, do you have any buyers for this? And they said, actually, we think we do. And we did a deal, albeit at smaller margins, but they had a buyer, they performed, they did well. And you have to just roll your sleeves up and get involved in this market, right? But let me tell you about a really interesting thing that happened last week. We had a property in the East Midlands that was going through a traditional agent, basically, right? No, sorry, I say traditional. It was going through an agency, so we're selling it through an agent. And we had a buyer that they paid a really, really good price for it, and we were happy, and everything was kind of going ahead. Now, that buyer was supposedly a mortgage buyer. So we said to them, look, it's a 3 months. So they took a 1% reservation agreement and fee, and it was a 3-month contract. Came to the end of 3 months, and he was like, yeah, I actually need longer. And it turned out he negotiated with the agent 6 months, not 3 months. Little did we know that. So he said, actually, I can complete in December. So he held off from paying for searches. He held off from the survey and all of this kind of stuff. So I said, okay, fine. I just chucked it into auction, knowing fully well that I don't want to sell it in auction, but I chucked it into auction with a really low guide, really low reserve. And every day he was calling up the agent, what's going on? Why have they put it into auction? I want to offer. We just withdrew contracts basically from him. And I took the motivation from us trying to chase him to actually, I was sat back kind of waiting for him to chase us. And honestly, it came to the day of the auction, like literally within minutes. And he was going back and forth. I'll put down £5,000, but it's refundable. No, it said no conditional contracts, unconditional. He kept on going back. And in the end, he ended up doing an unconditional agreement about 2 minutes before the auction. But the auction forced his hand, right? So I think that's the kind of stuff that we're having to do to work harder, because people are just being flaky. You know, they don't want to commit. It's as simple as that.
Yeah, and also it's like that's how you kind of get to know the good people or the good traders, the good auctioneers from the ones that are just trying their luck. And this market shows people's true like skills and abilities.
That's what I'm hearing as a non-auction expert, that it's taken a more strategic approach rather than they whack it in, just a choice of if it's that one or that one. It's like, actually, what is the best? There's more kind of thought, more effort required into, excuse me, what is the best strategy? What will get us the quickest exit on this? If it's trading, quickest exit on this specific property.
Yeah. I mean, Helen, from your side, it'll be interesting to kind of see, because I know you're kind of more investor / got developers hat on, not because you are developing yourself, but mainly because you're investing into that. But I mean, on the development side, because I don't really keep close to the development world, but what is going on that side? Is it people trying to reduce the amount of developments they're doing? Is it people trying to increase their margin by going more, you know, brown belt without planning and trying to go through the whole planning process? So what is the kind of situation on the development side of things?
It's interesting, actually, picking up on something that Jay said, that, you know, kind of the buyers in auctions are being more considered and kind of taking longer, and maybe not rushing to buy something, waiting to see, you know, if it's not a no-brainer purchase, waiting to see if it doesn't sell or gets relisted. Because, you know, as you all know, that's definitely my approach, slow and cautious in development. And it's really what I'm seeing more and more. Those decisions, those conversations, that courting period for an investor is taking longer and longer. It's not like, I've got this deal, I need the money by the end of the week, have you got it? It's like, whoa. No one's moving that fast. Everyone's coming to the tortoise side of the fence with me. Yay! Which I love. But in terms of what's being done, to be honest, and actually now you're asking, I'm only just thinking about it, I am seeing less proposals across my desk, which is probably says something in and of itself. So certainly, yeah, opportunities kind of slowing down on that. And I don't know if that's also a bit like chicken and eggy, or no, I need to think more about that one.
Chicken and egg, you mean in terms of the kind of people trying to more time the market in terms of developing to sell at a certain point, or just more in terms of like finding the funds to buy and develop the sites?
Finding the funds, like, because the funds are taking longer or slower to come in, is that making people kind of more particular about what projects they will take in, whereas actually when the cash is just sat there, you ring up your mate and go, have you got 100 grand or whatever to chuck into this deal, then people are actively out there kind of looking for something. Maybe people are being more strategic in the choice and the development also, because maybe margins are getting squeezed there too.
Maybe there is other alternatives nowadays. So opposite to Tina, that people are getting decent returns. And I actually do worry about the development side of things, because development returns as an investor was great when the banks weren't basically giving out any interest. But right now, what you're having to do, double the amount of interest you're offering to investors to make it even more appealing. And can you even?
But developers aren't. They're still stuck in the rates from, or in their minds are still stuck in their rates from. What have I seen stuff go up to? Maybe kind of 12%ish. Well, what security are you giving me for that? Because I was getting that before rates rose.
Yeah.
So that doesn't appeal anymore.
It's not as attractive at the minute, I guess, really, is it? And I think a large part of that is also because development is way more riskier as well in today's environment and where we're at today. So actually, is that development risk being priced into the interest rate that you're getting? I'd argue it probably should be more 15 to 18% in reality. My problem is the development going to be able to handle those returns?
Exactly. Exactly, and that's where the margins are getting squeezed. The lender, be it private or otherwise, needs that kind of cushion. But obviously, then again, it's kind of you're causing your own problem, because you actually by asking for that increased interest rate, that risk premium, you're actually kind of adding risk into the deal because you're increasing the bottom line. So you have to be bloody sure that that prices are going to continue to rise. When you're looking in development, 18 months, 2 years ahead, and where can you say that of? You have to be very clear on your market.
So I mean, naively, this is very naively, because I'm by no means anywhere near a developer, but naively, outside of thinking about the funding and the finance, just thinking about development deals in general, developers, you would think, would be in quite a strong position at the moment, right? Because you've seen recently land value starting to reduce a little bit, and the reason for that is that there are really good reasons to be buying land cheaply, or for people that own land to be selling it cheaply, because they know the cost of build is high, the timelines are high, etc. But if you are looking to buy a property now and realize its true value in 24 to 36 months, you've got to be thinking now is a good time. Now is a kind of not depressed market, but a constricted market, where you'll be looking to pick up something that you would have 3 years ago seen as being massively undervalued. I mean, even with the increased cost, and the old adage still stands, you make your money at the point of purchase. Well, the deals are there to be done now. No one's doing those deals. You could, and all you have to do is you have to have faith in your ability to execute, and faith that in 36 months the market's going to not be as sick as it is now. And if you don't have faith in those two things, don't do the deal. But that stands for the timeline of a development for the last 100 years. It still stands. The finance definitely, it's going to be an issue.
The problem with that, though, is, Jay, you probably, as you probably know, like with developers, they're very much I found a development, I'm starting my development, I'm head in the sand, executing this development, not thinking about what's going on for my next development or my pipeline or anything. They're not pipeline builders. The people that are pipeline builders, likes of Richard Littles and stuff like that, they're more on the land promotion side of things. So they're really looking at how can I get this strategic land ahead of time, get really strategic agreements in place with these guys, whether it is farmers or landowners or whoever it is. The problem is farmers, and farmers own a hell of a lot of land, right? Greenbelt, but also they own some brown as well. but they're not motivated because a lot of these guys own it, you know, unencumbered. They've literally got, they don't really have expensive lifestyles as such, because obviously they live on their farm or whatever it is. And actually their mindset is very much I'll hold this for another 10 years, 20 years, but don't really care. You know, I want to get the right money for it. And I think what you're maybe more thinking of is the kind of stuff that you get into auction as a developer, that kind of stock, which is quite different from the more strategic stuff. And that kind of stock is more developer will finish a development, then get their head up. What's in auction this month? That's the month when Piotr's like, it sold in October at 410, but it didn't sell in September at 400.
Yeah,
that's what's happening at the minute. It's all about timing. It's like, I've just finished a project and sold it. Now I've got the money. I'm going to be looking at what's next. They're not thinking I need to get the best deal. They're just thinking I need to get a deal. You know, and I think that's the kind of key difference.
Another thing that I've noticed is that they either don't want to pay for the land, right? So step one, I don't want to pay for I don't want the land value. I'd rather do a JV with the landowner. I'd rather do X, Y, Z, whatever it may be. Or it is a subject to planning, right? I'm not doing the deal unless I get the planning in place. And then it's the other thing I noticed is they don't want to buy something that already has planning, because then they feel like someone's already taken some of the profit out the deal. So when you look at those three pillars, you think, how are they doing any deals at all? I mean, you're talking about, you know, navigating. Okay, that's got planning, but I don't want to do it because someone's going to be making 100 grand that I could be making, so I'm not going to do that. But I don't want to do a deal without having the planning, or I don't want to pay the land value. Then you start thinking, well, they're not really in it to do a deal, and that's what you're seeing, right? You're seeing a lot of developers either going bust, or a lot of developers just not doing deals.
Yeah. And I would say to that, like, you are seeing a lot of that, and that's because very often developers aren't clear on what their niche, what their expertise, what their strategy, but like, which bit are you good at? Like we've talked about Richard Little, very bloody clear, right? It's strategic. He's buying stuff for here. There's a long-term plan. When you are, do we buy it with planning? Do we not? You're looking on an individual deal by deal basis. It's much harder, therefore, to build out a pipeline, and you have less experience at adding the value in whichever part of the chain, whichever part of the process you're getting in at. So yes, I agree with what you're saying, and I think that's why.
Some of the best developers I've seen, though, Jay, are in one strategic location. It probably is London or within the M25. One location, they know it like the back of their hand. They will still buy stuff with planning, but they find another angle to add more units or do something else, right?
Yes.
And they're working in very high value areas. That little angle can add 30-40% to that potential development, and that's where their cushion is now being built in. And those guys normally don't need funding because they're very clever and they've got, you know, kind of larger funding partners or whatever. But that's the stuff that I've seen. So yeah, Piotr, I know it's 9:40, so we need to start wrapping up.
Yeah, we need to start wrapping up. Just want to bring up a couple of comments. I need to leave early today. But John said it's not stamp duty, land tax when buying in England, a bit of a killer for most flippers. I think actually when people look at stamp duty in other countries like in Europe and stuff, it's actually probably higher, much higher than in England. So I don't know how it is in the US. But
I mean, it's just
if you're a trader, there are quite a few ways to mitigate and even remove stamp duty entirely. So, you know, for people like myself, Piotr, and Saif, as traders more than flippers, you can mitigate away quite a lot of that stamp duty. So if you're smart and you structure your deal correctly, you can almost remove that liability, and then that just increases the profit margin, which is nice. Yeah,
I think what people don't realize is trading properties is a crystallized, you'd hope, profit in most cases. And actually with that comes, you know, you're going to have corporation tax, you're going to have to factor in, you're going to have frictional costs. So what people don't realize is you've got legals on the way in, you might be covering the seller's legals as well. So that's two sets of legals on the way out. You've got sales fees on the way out, whether it's a estate agent or auction. You've then obviously got, if you have a stamp duty, you have stamp duty on the way in. And then no one factors in things like utilities and council tax and insurance. Empty home insurance is way more expensive than tenanted home insurance,
Yeah.
and then you've got to factor in cost of finance. So actually, there's a lot of frictional costs involved with buying and selling. But this is my problem with flipping, right? On top of those costs, you've then got builders' costs, and then you've got a longer bridging period or finance period, which you've got to factor in. And that's why I think the risk increases greatly if you're flipping versus trading, because you're holding for short periods of time. I mean, we traded out a property last week, quickest one we've ever traded out. From completing on it to actually auction was 3 weeks, right? Paid 122 for it, sold for 155 plus fees. It was 161 all in. The guys that bought it were so eager to get involved, they completed it in 8 days after the exchange of contract at auction. Yeah, they had 28 days. They were like, "Can we complete it quicker?" I said, "Of course you can complete it quicker. Go for it. You know, here's the key safe code.
Do you want more to buy more from me?" Yes.
Exactly. So our cost was basically 1 month's worth of bridging plus the 1% or 2%, whatever people pay these days for the entry fee as well. So really, all in 2 to 3%, not a lot of money. So, you know, versus if we're going to be developing that out and all the rest of it, that's a 9 to 12 month project. You know, you have to wait to sell it and all the rest of it. So, yeah, personally, I think you've got to factor all of that in when you're looking at flipping versus trading.
Yeah. Brilliant. Okay, guys, we need to wrap up a little bit early today, but next week we should be here for the full hour, most likely.
Cool.
Yeah, brilliant. There's more questions that I guess we can answer through the chat. Thanks everyone for getting involved. Thanks, Saif, for jumping in last minute.
Thanks, guys.
And see
Happy
you guys
bonfire
next week.
night, everyone in the UK.
Oh, and Helen, you wanted to do a bit of a...
Oh, just very quickly. Yes, I've put out a post about an awards that many of the Property Sisters are attending next year, 22nd of March. It's the Inspiration Women's Awards, and it's super cool. It's going to be an evening full of celebs at the Landmark Hotel, and they get to sit on your table and you can chat with them. But really cool people doing really inspirational things. Mary Berry won the Lifetime Achievement last year. Any Mary Berry fans or Bacon fans? Annie Lennox has won them. I mean, there's all sorts of people. So have a look at my post. If you'd like a seat at our table or you want to take a table yourself, get in touch because we're organising that now. And the tables are selling really quickly. So, yeah, let me know.
Amazing. Very good. Thanks, Helen. Thanks, everyone. See you all guys next week.
Have a
Lovely
good one.
weekend.
Bye, everyone.